Welcome to the Wealth Standing Podcast. This is episode 447. Today is May 21st, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, yesterday, my friend Arturo texted me and nudged me and reminded me that I haven't posted a podcast for over a month. I don't know how that can be. It seems like just yesterday I put out content. Well, hey, no excuses. I'm your introverted podcast host, but in a world of nonstop talking heads, I'll consider my lack of producing content a virtue and leave it at that. Hey, in any case, I want to talk about a couple narratives that are really predominant and that I've got a lot of questions about. I'll get to that in a second. Just on a personal note, in the Pugliano household, we're extremely blessed. Our cup runneth over. Today, we welcomed our 11th grandchild into the world. Children are a heritage of the Lord, and they pay eternal dividends. But hey, on to making money. Someone's got to spoil those grandkids. So let's talk about what's going on in the markets. You know, the big narrative right now in the media, well, really, there's two big narratives, and there usually are. You know how the talking heads work. They always have to have drama and a conflicting dialectic. It always has to be feast or famine. It's all about promoting fear and greed. And right now, the two big prevalent narratives in the media is that we're either headed into stagflation or we're just about to enter a new super cycle. Now, in terms of the super cycle, it depends on what exactly they're trying to peddle. And so the super cycle can be anything from, we're headed into a commodities super cycle, or maybe it's artificial intelligence euphoria, or crypto or gold, or, the bottom line is someone is promoting something that's going to the moon. Listen, as with all things, I don't think we're about to totally fall apart and enter into 1970 style stagflation, nor do I think that any one asset class is going to the moon is going to make you rich overnight. The current status of our economy is pretty much like it always is. It's full of uncertainty. It's going to mutter and meander along, and over time, the most productive, profitable, and growing companies are the ones that will ultimately pay the best returns. But hey, short-term, anything can happen, and we remain in this post-pandemic, schizophrenic, headline-driven market, which is why I've remained very concerned for quite a bit of time. And concerned isn't the right word. I've been very cautious and moderate in my approach because we continue to receive risk-free money market interest rates that for the first time in probably, 15, 17, 18 years are paying a real rate of return and don't have any exposure to the variables, the very fickle nature of both the stock market, the real estate market, or the debt markets. I'm already digressing. Listen, we needed a good, solid recession last year to pop the bubble that we're in, this bubble of everything. We didn't get that. I think that was the Federal Reserve's intent last year, but they don't want to create a recession this year during a presidential re-election cycle when they want to get their guy reelected. I don't say that to be political. I just say that to be factual. Connect the dots. The Federal Reserve is hell-bent on either reducing interest rates or at least presenting the narrative that inflation is under control and they're ready to reduce interest rates and that their interest rate policy is restrictive, even though, again, when you look at the world around you, that's not the evidence that you see. The major indices, not only the U.S., but of most economies, or at least the major economies, are all at or near record highs. Gold, copper, putting in record highs. Silver is, I think, at an 11-year high. Cryptocurrencies, at or near record highs. And this is at the same time when interest rates are at the highest they've been in, I think, something like 22 years. And the interesting corollary to all that is that even with things like precious metals at or near record highs, the U.S. dollar is holding up extremely well. Yeah, it's off of its peak in maybe 2022, but not by much, maybe 5 to 6% or so. Certainly if you pull up a long-term chart of the strength of the U.S. dollar, it's at one of the higher points that it's been over the last decade or more, with the exception of that brief spike that it did up in, I think it was the end of 2022. So we continue to be in a bubble with everything where all asset classes, in my opinion, are overvalued. The S&P 500 is trading at something like 21 times forward earnings. Now, while there's a lot of good growth and profitability that I think is going to come out in the future, especially from artificial intelligence and the productivity gains that will, filter out through the economy, that's still a very high valuation for where we are right now, especially in comparison to what you can receive in risk-free money market funds. Again, I digress. Listen, if you follow my blog over at investablewealth.com, the blog and alert notification section, you know that over the last 8 weeks or so, I've added 25 stocks to my portfolio. And I intend over the coming weeks and months to continue adding to my portfolio. But I'm taking moderately small positions and diversifying that over various sectors of the economy. And while I am investing in some stocks that have price per earnings ratios that are on the higher end of what I would normally invest in, or at least on what I think is not a value situation, I'm only doing that in cases where I think their future growth potential justifies those higher valuations. And if you look at it from that perspective, I think that everything that is currently in my portfolio and everything that I'm going to be adding to my portfolio can be categorized as both value and growth. But having said that, I still maintain a large pile of cash right now, and even once I'm fully invested for this cycle, I will remain keeping some money in dry powder because I think that we are in a very precarious global situation. The war in Ukraine has dragged on for almost 2.5 years at this point. We're no closer to resolution than we were in February of 2022. And look at the Middle East. The situation in the Middle East doesn't look like it's getting better. The Cold War with China is heating up, and we are seeing industrial policy not only expanding in the developed markets like it hasn't in probably 80 years, but specifically in the United States, for both political reasons and for defensive reasons. We're seeing tariffs and restrictive trade and other forms of industrial policy that literally haven't been used since we were either in world wars or in Great Depressions. I don't say this as a matter of projecting gloom and doom. I just say it as a matter of fact of what's happening. The situation and the events that we're living through right now are not means for despair. On the contrary, I think they're providing excellent long-term growth opportunities and investment opportunities. And that's exactly why I want to be migrating out of a cash position, because eventually these short-term interest rates aren't going to be paying 5+%. And when they're no longer paying that, I want to have my money invested in high-quality liquid stocks and asset classes, and that are not only trading at reasonable price per earnings ratios, but also price per earnings ratios and valuations that are driven by growth. Growth at a reasonable price is the bottom line, and it's what builds long-term wealth. But I digress again, and maybe I should create content more often than every 6 weeks or so I don't have to cram it all in. Hey, let's get to the bottom line of what I want to talk about. And that's this dual conflicting narrative of stagflation versus supercycle. 1 second. Let me digress even further. One other point I want to drive home about the current market situation, and not only its volatility and its precarious nature, but also the absolute stupidity that continues to persist since the pandemic and post-pandemic recovery. And this is a point I meant to make a few minutes ago. So where I was going with the fact that we are in this everything bubble, and I really think we needed a recession, a Federal Reserve raising interest rates induced recession last year to kind of clear the deck and reshuffle things and start out from a level of some type of sanity and reasonable valuations on asset classes, because there continues to be pockets of just extreme nonsensical pricing. Look at what happened last week to some of the meme stocks, the old familiar GameStop. I know, a company that literally should have probably been in bankruptcy reorganization 4 years ago. If you followed the news last week, there was a post from, the guy, I think he's called Roaring Kitty. And while you would think that no one would take someone with that kind of a name seriously, that isn't the case at all. He put out a tweet, I think it was last Tuesday or Wednesday. That tweet sent GameStop spiking, I think something like close to 300%. And then, of course, it's fallen back to earth, and I don't know, I think it's up maybe 10% from the original post. But that gives you some kind of an idea of the irrational exuberance and the stupidity that still dominates in the stock market. And that type of nonsensical speculation is a clear and present danger to the short-term performance of the market. Now, long-term, it all works out because valuations do matter over time. But I think there's a lot of hidden opportunity in individual stocks under the radar as long as you don't think that any one investment is going to go to the moon and make you rich overnight. Diversification across multiple sectors of the economy in companies that have reasonable valuations and above average long-term growth, I think that's where the money's going to be made. Okay, let me rein this all back in because I went far out on a tangent that I didn't intend to do. Bottom line, the dual narratives that we're either in stagflation or we're either in a pending supercycle that's just going to go to the moon tomorrow, I don't think that's at all an accurate description of the type of economy, not only in the U.S., but globally, that we're facing right now. Just as one example, look at the extreme price in copper right now. Copper has literally exploded over the last, 3 months or so. But if you dig down into the data, it seems to be driven almost entirely by speculation. Yes, inventories of copper have been lighter than normal, but that's because China, a country that consumes half or more of the production output of copper, the Chinese economy is still in a slump. And although they maybe have bottomed and they're improving, their current consumption of copper is nowhere near what it was back in the heyday of their, double-digit type growth. And it doesn't appear that they're going to get there anytime soon, especially with all the other Western world industrial policy and export and tariff constraints and other capital constraints that are being imposed on the Chinese economy. So copper seems to be in severe backwardation. And the very fact that prices are so high right now, that's going to further contribute to demand destruction, while it also fuels more production capacity that maybe isn't needed in a global economy that's not as robust as it was 5 years ago. And again, focusing on all these distortions in the market, it sounds like I'm making the argument not for a super cycle, but the other side of things is saying, well, we're in stagflation. And while I don't think that inflation is going back to where it had been the last 15 to 20 years, I think that was induced mostly from the overcapacity that we saw through globalization, and those trends have drastically reversed since at least 2018. But the argument against stagflation, the argument I have anyways, is that while I do think we're going to see higher inflation because of the industrial policy, because of the return to a Cold War, because of the loss of the peace dividend that has been around the last 30 years or so since the collapse of the Soviet Union, all that's going away, and that's going to lead to higher prices. So that's the inflation. That's what I agree with. But on the other side of the coin, I don't necessarily agree with the stagnation part of the narrative. Because if you look at when we had stagflation in the mid to late 1970s and into the early 80s, there's virtually no comparison. I mean, even with interest rates and inflation levels, this cycle, our inflation peaked at about 9%. It stayed there for like a day. We are nowhere near the long-term global inflationary trends that we saw in the 1970s and 1980s because the world is a totally different place. During that period of time, just from the baby boomers coming of age and from the emerging and the developing markets, that we're seeing a historical explosion of not only population, but of productivity and consumption. Well, we're not in that world anymore. Birth rates are flat to declining. The global population is aging, and then specifically from an American and a North American perspective, back in the 70s and the 80s, the stagflation was characterized by the fact that industries and jobs were rapidly leaving the United States and going to promote the globalization that took place when we had the development and the huge expansion of not only established economies like Germany and Japan, who were exporting giants in those days, but also remember the Asian tiger nations? That was Hong Kong, South Korea, Taiwan, and then all that led into the explosive growth that occurred in exports from China when China was admitted into the World Trade Organization, in the late 1990s or early 2000s. So those were the heydays of global expansion, global growth, when jobs and industries were being exported out of North America and out of the United States. Today, we're seeing a lot of that getting reined in. And so while we are going to have higher prices because these industrial policies and these industries returning to more developed nations are going to come at a higher cost because environmental and regulatory costs are higher. But at the same time, that's creating jobs and employment in the United States and in North America. And so while I think inflationary pressures are going to continue to build, I don't think they'll be on the same scale as what we saw in the 70s and 80s. And likewise, we're not going to get to stagnation because the economy of the U.S. and of North America is benefiting from a resurgence in manufacturing. And this isn't just about artificial intelligence hype or political policies like Build Back Better or policies of energy transition. I mean, those are all additional factors. But if you go back to the book that I wrote in 2016, where I talked about the impact that robotics and automation would have on the U.S. and the North American economy, it all plays out. It's happening faster than I anticipated because of COVID and the supply chain disruptions and the need for friendshoring because of the escalation of the Cold War and an even more rapid decline of globalization than I thought would be taking place. But the premise is the same. The jobs and the manufacturing and the production that left the U.S. post-World War II and drastically escalating into the 2000s when China came into the World Trade Organization, that dislocation occurred because of lower manufacturing costs outside the United States, whether it be labor or regulatory burden or other factors. But because of the revolution that we've seen in energy, where the U.S. has effectively become energy independent and an energy exporter, all those changes that started occurring after 2005 or so, when horizontal drilling and fracking became more productive and more efficient, at the same time that robotics and automation and artificial intelligence and really the Internet of Things is converging, that we were headed to a point when manufacturing could be cheaper and cleaner and of higher quality in the United States and North America. And you combine that with the fact that the resources are primarily in and around North America anyways. I mean, look at all the things that China has to import just so that they can convert it and ship it back out again. But we have those resources focused around North America. And this is also where the major consuming market is. So it's a win, 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 win on every aspect. Manufacturing and production was destined to be coming back to North America. And if there is truly a super cycle, that's what it's going to be. But again, it's not going to happen overnight. It's not going to be focused on just one sector or one company. It's going to be broadly dispersed throughout North America. And despite the high valuations of the markets that we're in right now and the over-speculation and my concern about geopolitical and all these other issues, the bottom line is that I believe there has never been a better time in the history of humanity, not only in terms of just investing, but in terms of career development and starting a business and investing in yourself. That yet again is another reason why I'm ecstatic and thrilled to be welcoming an 11th grandchild into this world, because I think the opportunities for prosperity and wealth have never been better. Hey, come on back. In the next episode, I want to talk about how the Federal Reserve is talking out of both sides of their mouth. And while they talk about restrictive interest rate levels, that's not what their policy is dictating. But until then, as always, this is John Pugliano wishing you the very best returns.